Okay, guys, welcome back to the channel. We're going to start our live stream here in just a bit. We currently have about 20 minutes to the bell. Just wanted to, you know, come on here, show some things. I'm not going to be on here that long, but I'm going to go over the charts in just a second. Yeah, and we'll just wait for some people to filter on in. So it's 2023, the second trading day of the year. And how great does it feel to start a fresh new year? So when we do this, we start this fresh year, we look back at 2022, we see the mistakes that we made, and we correct them. All right. And that's what I suggest that all of you guys do is look back at your trades, and you can find an awful lot of information there that you may not have been aware of. Even if it was so obvious, it's good to go over your trades and see what strategies worked. 2022 was obviously the year of extreme volatility. You had some nice periods of call buying. You've had nice periods of buying puts or shorting the market. As the market was down, it was just in a downtrend the entire year, and that continued yesterday. So trade with the trend. And if you're going to do that, you have to wait for good entries. And that's what I'm doing this year, setting alerts and only getting into positions when those alerts trigger instead of chasing that FOMO. I can't tell you how important that is. If you miss your entry, there is plenty of days to trade in the market. Do not chase that FOMO and set yourself back. It's just not worth it. So that's what we're going to do this year. And by we, I mean me. Going to set alerts. And I did that yesterday and missed my alert on the SPY to take puts and on AMD as well, by cents. By cents. Now, the move up in the morning, it didn't last very long, so it was very difficult at that time to really get activated and get in there and take a position. But, it is what it is. The good thing I did was I did not chase FOMO, and I ended up with a $230 day. Very well disciplined start to the year. So that was good. What's going on, Rob? So Rob had just posted this chart that you guys are looking at in our Discord group. And it's very, very interesting. So you can see here, this is the S&P 500 bear markets, peak to trough since 1927. So the crash of 1929 is in here. That's right here. Looks like it was down about 43% or so. And then you have the tech bubble right back here, 2002, all the way down even further than the 1929 decline. Now, that took 3 years. So back in 2000, 2001, 2002, when the market was in just an incredible bubble, it took 3 years of down, negative, returning years. I can see the same type of situation, playing out. Does it have to be as much? No. But you can see here, we're only sitting at 19%, 20% so far. Now, you say only, but that is a very, very, very big decline for 1 year for the S&P 500. 19% is just a massive decline to end the year. Now, sometimes you'll see those intra-year lows that are, 20, 25%, but you get that rally. This one has really, this market has absolutely struggled. And it's so obvious watching the volume. And watching these days where you get a little push, I mean, it's just getting sold into. And there's such key levels there and overhead supply that just looks like it's going to be very, very difficult to break through that without first seeing a retest of these lows. It's just the way the charts look. So why don't we just get into first? Let's look at the economic calendar because in 45 minutes, we have some really important things coming up. At 10 a.m., you have the JOLTS, which is the job openings. This really, really moved markets last month. And this is what the median forecast is. This is what the previous was. All right. So that is going to be, hang on one second. I forgot to switch the screen here. Sorry, guys. All right. Now you can see it. All right. So right here, 10 a.m., the JOLTS numbers. This is what was forecast. So 10.1 million. We'll just have to wait 45 minutes and see what that is. But like I said, that moved markets a lot last month. And then you have manufacturing data. So what's going to happen now is going to be pretty interesting. You're going to have recession fears and Fed fears, which are kind of going to, it's kind of going to work against each other. Honestly, this seems like a very bearish setup because what most people are going to want to see if we don't want to see recession is we're going to want to see construction. We're going to want to see manufacturing, that type of stuff. We're going to want to see that actually beat expectations and maybe say, oh, okay, you know, maybe that recession that every single person is talking about is not going to happen right now. And then on the other hand, you have the jobs data, right? The labor market is one of the number one things. Now that we've seen inflation come down, the jobs numbers, any type of jobs numbers, and we see that with initial jobless claims every Thursday, it moves markets like it has never moved markets before. It's absolutely insane. I've never seen that before. But the Fed wants to see the labor market loosen up. It's simply too tight. All right. So the only way for that to happen is job openings, right? That's a number that people are going to want to see. The JOLTS, they're going to want to see less demand, less hiring. And then we have the initial jobless claims. They're going to want to see these up. It's the opposite of good manufacturing numbers. It's the opposite of maybe there won't be a recession. Because then if you get bad jobless numbers, oh, maybe there will be a recession. So I don't see a positive catalyst. We already know inflation is coming down. We've seen the numbers. So I don't see a very positive catalyst at the moment. And I think the market this whole year is going to be based on market sentiment. When things get way too oversold, you'll see bounces. When things get way too overbought and, you know, everybody is so bullish, you're going to see a pullback. And I really think that's going to be very important this year to understand market structure. Because these numbers, while they may move the market in the pre-market or for 1 day, 2 days, it's all going to come down to market structure and where that sentiment and trend is at the time. All right, so why don't we get into the charts? All right, so we have 21 minutes to the bell. This is the daily chart for the SPY, the S&P 500. All right, our daily candle, the first daily candle of the new year. That's what it looks like. So we had gapped up in the pre-market, opened the day, and basically just sold off. So after the first, 10, 15, 20 minutes, I don't remember exactly how long, the market just totally sold off and got right back into this very clear range. I mean, this range is as clear as day. You have support, which we saw the bounce right here. That was support. And then you have resistance right up here at the top and at the 20 EMA. Now you can see here my alert, this yellow arrow. I have the alert set if the SPY goes above that. And this is what I was talking about yesterday. My alert, which was set here at 38687, it missed that top by just maybe 40 cents or so and wasn't able to get into my puts. But this is where I'm going to be looking for puts. Why am I going to be looking for puts there? Because the trend has been down, right? What we have seen here with these moving average crossing over for the past year, you can see this crossover right here, the 20 going under the longer term. You got the 20 going under the 50. You got the 20 going under the 50, the 20 going under the 50. I say this all the time. Every time this has happened, the market has had a sell-off. All right, we're consolidating. This happened right here. Doesn't mean that you can't have a move up to these, 390 area, right? There is some room on the volume. And I'll show you guys that right now. So right here, you have a lot of volume right here, consolidation for the whole year. What this volume profile does is it takes whatever chart you're on. So in this case, we're on the daily chart. This is a year's worth of data and volume. You can see the point of control right here. I mean, clear as day. How do we break through all of this? If we couldn't do it here on a great CPI number and just sold off dramatically for 4 or 5 days, now you think there's a chance that we could break that? I mean, there's got to be, something that would cause that, and I really don't see it. I really don't see it happening. But you can have those global things happen, like Russia says, we're pulling out of Ukraine. You might get a random spike, something like that. That's not, the technicals are great, but you do have outside forces that can really move markets. But right now, we're consolidating right in here, and then you have this gap, right? A very clear gap right here where there's less volume, and if there's less liquidity, it could come back up to liquidity. So if we ever did break out of this consolidation, I have to think it wouldn't last very long. But I set my alerts, and I want to watch when price gets into that gap, how it reacts, and that's what I'm looking for to take this market lower. I do think that the lows simply are going to be tested at some point. Timing is tough to tell, but when you're consolidating for this long, you do know there's going to be a big move coming. So whether that's up or down, for me, looking at the technicals, looking at what I'm circling here, right? You can see these sell-offs, seeing market sentiment, and just where there's definitely more downside, less volume, less support, it does look like the market is going to retest those lows. Just from looking at the technicals. Doesn't mean it has to happen today. Doesn't mean it has to happen this week. All right? Like I said, when we get these crossovers, you can see that you can get a little bit of a bounce before the move sets in. This is just a lot of consolidation right here. A lot of overhead supply and a lot of, you got the down trend line, you have the 200-day moving average. If anyone was going to get long an index or the market, why would you do it right now? There's so much overhead resistance. In my opinion, this is just my opinion, but that's just the way that the charts look to me. And, you guys let me know yourselves if you think that would make sense to you guys as well. I'm just doing technical analysis. That's it. Taking emotions totally out of it. And that's why, I really like to do technicals. To me, looking at a chart like this, it paints the most perfect picture. All right? The trend is down. My moving averages tell me a story. The volume profile tells me a story. And interest rates being high this year, they're going to stay there. Everything is kind of pointing that way. Doesn't mean that has to happen, but that's just the way that I'm feeling at the moment using this. So if I take trades off of this, I've done my homework, right? I have my trade plan, and you just have to take those trades when you have them. If they don't work out, they don't work out. Not every trade is going to work out. But if you've done your homework and you have a trade plan, don't hesitate. You take the trade and you live with the result. And that is trading in general. And that's just what we're doing. That's what I'm hoping to teach you guys here on the channel. And that's it. What's going on, Eric? Yeah, so that's exactly what I'm talking about, what Eric just wrote here. You had a great CPI number. The market gapped up a huge amount. It even broke the downtrend line in the pre-market and then sold off for the rest of the day. So, and back here, this big green candle, this was a terrible, terrible CPI number. But guess what? Down here, what did I say at the beginning of this video? Market sentiment was extremely low already. RSI was extremely low already. So even with a terrible number, we saw the buying. So back here, we see an oversold market. We see the trend line. We have been in a rally here for about 5 or 6 weeks at the time. That's what you have to realize. So we were selling off for a couple of months going into this terrible number. There was just simply no more selling to take place here. We were going up here in just an absolute terrible situation, but sentiment was low and we saw that rally. Terrible, great CPI number, market sentiment, it doesn't matter. We sold off. This is exactly what I'm talking about. And thank you for bringing that up because, like I said at the beginning, this is the year for market sentiment. Watch that bull bear number. Watch how many people are very, very bullish or very, very bearish. And you can actually get some decent trades off of that. Because we can just tell just by looking at these two CPI reports that good numbers don't necessarily mean that the market's going to hold up if you're at overbought territory already. There's a lot of people that want to sell into that, and that's what they do. So retail, they push the market up 1,000,000 points in the pre-market, and then the big guys are like, thank you so much, what are you doing? But we're going to take all your liquidity right now. So don't be that person. So yeah, that was just my rant. I didn't realize how long I went on with that. We have a minute to the bell. So, we'll see what happens today. This is going to be this strategy that I'm doing now, right? I'm setting alerts and I'm going to be swing trading a lot more. So I'm only going to get into positions when I really, really like the entry. The risk to reward, that is going to be key. All right? So I hope that you guys have a wonderful day. 45 seconds to the bell. And yeah, heading down at the open as possible. And, hit the thumbs up for the video. Comment under it. And if you're new to these videos, subscribe. We have new videos just about every single day.